Many people know that over 50% of startups fail, so this is an extremely high risk.
What is a startup? By most definition, it's a fast-growing business with the goal of disrupting an industry. It's all about innovation and changing the world. But if you look closer, the reality is much more sinister. Many startups today are nothing more than Ponzi scheme disguised as innovative company. They are built on the idea of rapid growth and exit at any cost. But how come a startup become a Ponzi scheme, you might ask? Well, it all starts with the idea of disruptive innovation.
First they think you're crazy, then they fight you, and then all of a sudden you change the world. And
all kinds of things in order to get paid. They've created an extremely transparent and efficient business.
This buzzword has been thrown around so much, it almost lost meaning. I have $1 billion idea. I will buy smartphone for $1,000 and sell them for $800. I am about to disrupt the smartphone retail business. You don't believe me? It has already happened. Replace cars with smartphone, and you have Carvana, a $1 billion company losing money selling cars, while the automotive dealership business model is one of the most profitable. But remember, Carvana is not just a simple dealership business. It's a
disruptive innovation.
You see Carvana, you've got Nirvana. That's what this market's about, is finding the next Carvana.
Let's talk about startup funding. If I want to go through with my business idea, I need some capital. I can start by investing some of my own personal income, or maybe borrow from friends and family. This is called a pre-seed round. But if I want to really grow this business, I need more money. This is where big money come into the picture. Let me tell you how this plays out. After a meeting with a group of investors, they were blown away when they saw how many people wanted our smartphone. I mean, who would have thought? Some were skeptical when they saw how much money we lost, but others saw the real potential of the company. Think about it. The more people buy smartphone from us, the more data we can collect to train our large AI model to generate cutting-edge fraud detection technology for the metaverse. And just like that, we succeeded in raising our seed round, and now the company is valued at $10 million. Okay, things are getting juicier. We have way more money, so we can buy a lot more smartphones now. A few months later, we have grown our revenue tenfold. It's crazy, but we need more money to continue to grow. We show the result to investors, and they love it. They talk to other investors and tell them how amazing we are. So they also decide to invest in us during the second round of funding. We have more money now, and the valuation jumped to 100 million. We can buy a lot more smartphones, and once again we 10x our revenue in a few months. The growth rate is insane. Investors are happy and new investors are coming in. They don't want to miss out on the next big thing. So we have even more money now, and we can repeat the cycle. Do you see where this is going? At this point, you may ask yourself, if we have 100x our revenue, why do we need even more money? Well, revenue is not profit. We may have 100x our revenue, but we also 100x our losses. But no one cares. I mean, we are a startup, and only growth matters. After a few years of hard work, we finally did it. We are now a unicorn. We passed the $1 billion mark valuation, and everyone referred to me as a visionary founder. But something is starting to feel a bit off. Some of the early investors are not excited about the growth anymore, and they want to discuss about exit opportunities. And to be honest, I also think I deserve a nice payout for all the hard work, so it's time to go public.
2022 was a rocky year for IPO, one of the biggest IPOs since Alibaba.
There are many ways to go public with a company. You can choose a traditional, more difficult IPO path, or you can choose the alternative, more straightforward SPAC route. But it doesn't matter because it's short time. The first they listed on the Nasdaq, the company stock 5x. Investors are happy and they have their exit covered. 3 months later, after the first earnings report, people started raising the profitability question. They didn't understand that we are a startup and only growth matters. We don't need profit now, and we will make so much money when our disruptive metaverse AI model can predict fraud on the blockchain. But what if it never works, you ask? Well, early investor and I already made billion, so it's not that deep. The ridiculous scenario we went through is actually not that far from what is happening in the startup world. We have countless companies using this same business model, but a bad business model by any means make a company a Ponzi scheme, but combined with a funding system that reward growth at all costs. And watching company founder and early investor making billion while retail investors are left holding the bag, it starts to have a lot in common with a Ponzi scheme. With the rise of interest rate, some of these innovative, disruptive company are getting exposed, and we are starting to see a shift on how investors value company. Profitable company with solid business model are now more attractive, and that's a good thing. I mean, a profitable company is less likely to have its stock drop 80% in a month. Despite all the harm those speculative companies can inflict to retail investors, I will argue that there is a group of population that actually benefits from them. You see, startups usually use investor money to subsidize price, making the product or service cheaper. I remember when Uber was extremely cheap, forcing taxi company to evolve and offer a better service for a lower price. So from a consumer perspective, it's not so bad.